Good morning, good afternoon, good evening to the global trade community. My name is Dipesh Patel, editor at Trade Finance Global and host of the Trade Finance Talks podcast. We're delighted to be co-hosting this webinar with BAFT. Today, we'll be discussing BAFT's Digital Ledger Payment Commitment, or DLPC, and I'm delighted to be moderating this panel with Samantha Pelosi, Senior Vice President for Payments and Innovation at BAFT, Alyssa DiCaprio, Head of Trade and Supply Chain at R3, and Rebecca Liao, co-founder and EVP of SKUChain. It's no surprise that trade instruments from documentary, letter of credit to prom notes have been earmarked for end-to-end digitalization using blockchain and distributed ledger technologies. Yet since 2015, a number of networks, consortia, and platforms have come to the market, each offering various push and pull strategies to integrate into legacy back office systems of trade finance banks and financiers. The BAFT DLPC is a potential solution, allowing for digital representations of payment commitments on a distributed ledger. Last year, BAFT published its DLPC Technical and DLPC Business Best Practices, which have today now been updated and published. There are also live transactions, which we'll be getting under the skin of today. And I'm here with three working group captains to talk about DLPC with respect to trade finance. So in terms of the agenda today, we'll start by giving an overview of BAFT's DLPC working group, followed by discussing in more detail the newly issued DLPC Technical and Business Best Practices. Then we'll discuss how DLPC fits in with many of the other digitization initiatives within the trade space. We'll then go into discussing the functional role of DLPC, which will nicely move into some examples, live transactions, and case studies. So to start off with a quick elevator pitch, and Samantha, I'm going to start off with you. If you could all briefly describe in 30 seconds or less who you are, where you're from, and what do you do? Samantha, let's start with you.
Okay, thanks so much, Dipesh. I'm Samantha Pelosi, and as Dipesh mentioned, I'm Senior Vice President for Payments and Innovation at BAFT. I have a background as a regulator, a central banker in the United States, as I'm an attorney. So you're going to, unfortunately, perhaps for you, hear quite a bit about the legal and regulatory background and framework that we've developed for the DLPC. That will be coming from me. So I'm pleased to be here with you today, and I'll turn it over to my other co-speakers.
Rebecca, over to you.
Great. Thanks so much, Dipesh, and thanks everyone for joining today. I'm Rebecca Liao. I'm co-founder and executive VP at SKUChain. We are a blockchain company that focuses specifically on supply chain. In terms of my personal background, I started my career as a corporate lawyer and a recovering attorney. After doing mergers and acquisitions, securities financings, et cetera, on an international basis for many years, I transitioned over to startups and technology. My last startup was Globality, which is an AI-based system for procurement of international services, and I have been at SKUChain for several years. I do have a deep background in the policy side as well. I headed up Asia trade and economic policy for Secretary Clinton's presidential campaign in 2016 and remain active in those circles. But I am thrilled to be here and thrilled to share the work that we've been doing on DLPC.
Thank you very much. Alyssa, over to you.
Great. So I am head of trade and supply chain at R3. R3 is a blockchain platform company. We build a platform called Corda. Before R3, I was at Asian Development Bank. Before that, the United Nations, the U.S. Department of Commerce. I'm a trade economist, and so I largely focused on, how to apply blockchain to existing supply chain and trade finance problems, of which there are many.
Thank you very much. So, Samantha, let's level set. Would you please describe the concept of a distributed ledger payment commitment as used in BAFT's very recently issued technical and business best practices?
Sure. So perhaps we should let everyone know what we're talking about here. And we did just release for the initial use, the initial version for the industry's use yesterday, our technical and our business best practices. And I do know that DLPC and distributed ledger payment commitment is a little bit of a mouthful. So all we're talking about here is a payment commitment. And a payment commitment in trade finance is that most important kernel, a promise to pay in a letter of credit or a draft or a note, sometimes under certain circumstances, but there still is a promise to pay embedded in those negotiable instruments, those finance documents. So it's just lifting out that promise to pay out of a paper document, usually today, unfortunately, and making sure that it can be placed on a blockchain with the minimal information, but most critical information needed to effectuate the transaction. And then make sure that that commitment is legally valid and enforceable in a court of law if there should be disputes about it. So the DL part is just making sure your payment commitment is actually on blockchain and not another digitalized form. And then it's also the DLPC, all in caps, is just a sign that you've actually used the BAFT best practices that, again, actually are available in your handout section. There's a link there, but they're public and they're also available on the BAFT website.
Thank you. So, Samantha, what's the story behind BAFT's DLPC working group and also its decision to prepare best practices for the industry?
Yeah, well, that's a good question. So as you mentioned, Depeche, about 4.5 years ago when I came to BAFT, which is a trade organization from the Federal Reserve Board in Washington, D.C., blockchain, and especially blockchain for the use of trade finance, was front and center in everyone's mind, in the industry's mind. And a number of consortia were built to plug resources in to an effort to leapfrog prior attempts to digitize trade finance in any digital form over to blockchain, because blockchain has quite a few components that are extremely helpful in this case. So there's a single source of truth. You can screen out the participants so that only the exact participants to a transaction can see the details of all of that, of the transaction, maintaining privacy and various, corporate, competitive information, so that it can be used in the proper way. So everyone wanted to really investigate blockchain technology for trade finance to finally get these papers digitized, so there were a number of efforts and a lot of money and time being spent on raising up platforms and solutions for this purpose. We noticed right away that eventually these platforms were going to need to speak to each other or merge together. There could have been consolidation, but we haven't seen that as of yet in the industry. So to avoid having these technical and digital islands between the platforms, we decided that we needed to come up with some standards, some best practices around the information that would be in this payment commitment that could transfer between two or more blockchains, so that folks that were using one solution, all of the parties to a transaction wouldn't have to be on that one solution. They could use different solutions, but the different solutions could speak to each other, and a transaction could span several different solutions. So that's one thing. Another thing, and I promised I would give you a lesson on the law, is that in many nations, and especially under English law and U.S. law, the trade finance documentation are considered to be negotiable instruments. And as defined under these laws, a negotiable instrument usually has to be on paper and have an ink signature. And because of that, if it doesn't have one or those two characteristics, it's not a negotiable instrument. And hundreds of years of supporting law don't apply to it. So there's been some concern, obviously, with these large value and important trade transactions, that if you use a digital promise to pay or a digital document, will it really be enforceable if something happens and there's a dispute? So we did a paper, which we'll talk a little bit more about later. But we found that really, at least in the United States, where I'm a trained lawyer, there isn't this nice body of supporting law. So that's something else we set out to address in our business best practices in particular, and the rights and responsibilities of those parties in the business best practices.
Great. Okay, thank you. And I guess, Rebecca, moving on to you, it would be good to discuss some of the key changes between 2019 and the June the 1st, 2020 best practices, and kind of what the key differences are.
Yeah, absolutely. So first of all, thanks, Samantha, for that excellent summary. I would say that the documents that you're going to see, or that you may have already seen as the new best practices, will look very familiar to you if you've seen the previous versions. And so in terms of substance, not a lot has changed. But what we learned from industry feedback and from experience implementing the DLPC in live transactions is that certain aspects of the DLPC need to be made more clear. So the business best practices, for instance, one of the key questions that we got from a lot of platforms, banks, other stakeholders for trade finance transactions is, do I have to use Delaware law? Is DLPC valid under any other jurisdiction? And I'll let Samantha go into more detail on that later, but suffice to say for now that Delaware law is something that we researched extensively. It was chosen purposefully because Delaware has adopted the UETA and therefore recognizes digital payment commitments and digital signatures on negotiable instruments. At the same time, Delaware has a friendly commercial framework for digital instruments in general. And so we believed that under Delaware law, there is a very robust framework for enforcing the use of a DLPC. Having said that, none of the legal concepts I just named are unique to Delaware. Many other jurisdictions, including most international jurisdictions, have some conception of an Electronic Transactions Act. Obviously, they have analogs to the DLPC in paper format, in the form of notes, promises to pay, and therefore the DLPC can be used in those regimes as well. But we wanted to clarify that if you use Delaware, we believe that the risk is relatively low that the DLPC will be unenforceable if you decide to have other governing laws for the DLPC. It's not to say that it's unworkable, but it may be a little more legal work on your end to go ahead and justify that and have it be enforceable in a court of law. In terms of technical best practices, you'll see a lot more changes there, and those are in service of making sure that the DLPC is pretty informative about a transaction the first time you look at it. So I would say that the first version of the DLPC that came out was 11 fields, and you could sort of understand what was going on in the transaction by looking at it. But this time around, we expanded the DLPC to 13 fields, and we allowed a lot more descriptiveness in the fields themselves so that you could immediately look at it and understand, okay, this is what's going on in the transaction. These are the current counterparties. This is the current state of this payment commitment. And we also have some examples as to how to represent these fields in code. So before we move on in the webinar, I wanted to take this opportunity as one of the co-chairs of the DLPC working group to acknowledge all the members who contributed heavily to the drafting of the new DLPC best practices. So the group is made up of about 15 people, but there were a few who really held the pen on these best practices. So especially want to acknowledge John Taylor, Whit Knapp, who really did the heavy lifting on both of these documents. Andy Garner from Wells Fargo is our technical guru and did a lot of the heavy lifting on the technical best practices. Jenna Webkowski and Alex Thompson are both trade practitioners at their respective banks, and they were instrumental in providing feedback and really shoring up the concrete cases that you see in the technical and business best practices. Ed Smith and Eric Marcus are both lawyers, and they were instrumental in helping us explain the DLPC best practices better in the new versions of these documents. And of course, Samantha, Alyssa, both key members of the working group, Samantha doing the final review on the best practices. So thank you to all those members. I know that in the fog of publishing new documents, sometimes the individual contributors can get lost, but I definitely wanted to acknowledge everybody's contribution and authorship. So thanks, Dipesh.
Thank you, Rebecca and Alyssa. I guess over to you. You've been involved with the working group since the beginning. Can you walk us through some of the highlights of both the technical and the business best practices that were released very recently?
Sure. So I'm largely going to turn this question over to Rebecca and Samantha, but I think it's important also, to introduce, what was going on. I mean, the working group really came out of a blockchain pilot that ran into a wall. So the bank that was involved in the pilot had really realized that there was no way to properly track the payment commitment, and throughout all of the partners. And so this working group was a way to think about, okay, is this an industry-wide problem, and how can we solve it? Which is kind of illustrative of more generally what we see in the banking space, where we see financial institutions getting together and say, okay, well, we could probably solve this on our own in a very specific application, or we can try to solve this for the entire industry. So that's really where this sits in kind of the way that the global movement of trade finance is happening. A lot of the initial work was on mapping out the flows of the payment commitment, because it's unclear where this each bank is representing it differently, using different language. The obligors change over time. So really mapping out the flows, very difficult. In the blockchain space, we do this all the time, and it always looks easier from the outside. You're like, that should take 5 minutes. Absolutely not. It involves so many different departments and so many different entities arguing with each other that it takes a bit longer. So the objectives of the documents that have been published were basically threefold. To understand the legal background behind it, the legal framework for it, the business framework, and the technical framework. And these are, three very different components, but all of them are necessary to be able to make this into a more standardized representation that can allow the type of interoperability that we were looking for. And getting the right experts in those three areas, as Rebecca pointed out, is very rare. And having them be able to have a conversation with each other using the same language was part of the working group process. So, I guess I would turn it over to Rebecca to talk about the technical or the sort of business side of this, and then Samantha can work on the legal side.
Yeah. Okay, Rebecca, I'm going to turn to you, I guess, to go into a little bit more detail on some of the functional side of things.
Yeah, absolutely. So first, I'll do a brief highlight of the changes in the technical best practices, and a little bit about the business side as well with respect to the flows. And then I'm sure Samantha would love to highlight what's or the new information about the legal backing for the DLPC. So in terms of the technical best practices, a few things have changed of note that I'll bring up here. First is that we have slightly tweaked the life cycle of a DLPC. So there's, first of all, the pre-DLPC. When we implement any sort of blockchain, we anticipate that there will be a lot of legwork in the transaction that's not done directly on platform. And a reference to pre-DLPC in the best practices is just to acknowledge that reality, that there will be negotiations, discussions about a transaction before you want to finalize anything and place that data onto a blockchain network. So that's pre-DLPC. The very first step in the official life cycle of a DLPC is initiated. So a DLPC is first initiated and then put onto a blockchain network. That's to let the parties know that we have enough information about this transaction. There's enough contractual backing and intent between the parties to go ahead and initiate a distributed ledger payment commitment. From there, we move on to contingent DLPC. Contingent DLPC, many of you who are in the trade space, you might think of it as a letter of credit that is open, for example, but for which documents have not yet been presented. It could be another sort of negotiable instrument where there are conditions for final payment being made, but those conditions have not been met. Typically, this does mean that there is some sort of documentation that needs to be presented. But in that period, we represent the transaction using a contingent DLPC. From there, we move on to an effective DLPC. An effective DLPC is a legally binding promise to pay. So the DLPC, in addition to being a digital representation of a payment commitment, it is a legal object in its own right. And so it does represent an actual promise to pay. Once a DLPC's conditions for payments have been met, it becomes effective and those legal obligations kick in. Finally, once the DLPC has been paid off or canceled, then it is discharged. And there we have the full life of a DLPC: initiated, contingent, effective, and discharged. I won't bore you about all the individual details of the 13 fields in the DLPC, but a few things that are worth noting. We got some feedback the last time around that one of the big issues we wanted to solve was how exactly to identify entities who are engaging in this transaction. And the first time around, the solution was an LEI. Some of you may be familiar with that kind of identifier. An LEI is eminently useful. I think that LEI is gaining a lot of traction in the industry precisely because it is a universal identifier for an entity. Having said that, not that many businesses currently have an LEI. It's pretty simple to sign up for one, but in order to reduce friction in a transaction, we decided to eliminate that, actually. And so entities now can be identified according to their legal name and address, as well as a combination with pieces of data that you would readily know at the time of transacting upon the DLPC. So that's how we identify entities for now. There's also a reference to the trade instrument itself that will provide a way to track the actual documentation. We anticipate that most systems that implement the DLPC will do what FutureChain did, which is attach some version of the underlying trade instrument itself. And the reference ID that's located within the DLPC is a good way to just track the two together. Other commonplace pieces of information you're all very familiar with: currency, amount, date, for example. Last piece I'll mention is, again, in the applicable rules section, which is the very last field of the DLPC. That's where you can decide on the legal framework that applies to this particular DLPC. It could just be the BAFT, Best Practices, or it can be some other body of governing law. But again, there's a little more freedom there to describe what framework you're implementing the DLPC with. So I would highlight those. Thanks.
Thank you, Rebecca. And I think our audience can find out more about those 13 fields on the downloadable guidelines, which are available on this platform, and also will be available on both BAFT's and TFG's website later on. I think just going into the legal best practices, and I know we hear the saying often, code is not law, and perhaps Samantha, I'm going to turn to you here. Could you tell us a little bit more about the legal framework provided by the business best practices? Because I guess that's key to the DLPC success, right?
Yes, that's definitely right. So Alyssa and I, Alyssa representing R3 and then myself representing BAFT, together with the law firm Sherman and Sterling, about a year and a half ago, wrote a paper entitled Code is Not Law, which is somewhat ironic because, yes, computer code is not law, but actually the UCC is the Uniform Commercial Code, and that code is, in fact, law. Anyhow, we set out in that paper to see if the UCC and other statutory law, as well as common law in the U.S., would be supportive of a digital negotiable instrument, a digital payment commitment in any form, whether or not it was on a blockchain. We found what we expected. Unfortunately, the answer is no. Something that does come somewhat close is the UETA, which is somewhat, I'm really kind of dulling this around the edges, but is somewhat of a shorthand for a lot of the provisions in Article 3 of the UCC, which is all about negotiable instruments. So that, unfortunately, had not been adopted in the key state of New York, because most of these trade finance instruments are either governed by English law or by the state of New York, because they have such well-developed commercial law on the books. So that didn't end up helping us either. And then the UCC itself, we could make amendments to that. We could make amendments to the UETA, but both would have to be researched by the Uniform Law Commission, which is the body that drafts the UCC. And then after the wording was settled upon by these experts, each of the 50 states of the United States would have to adopt the same language. That's quite an undertaking. So to drive this process forward, the adoption of any kind of digital negotiable instrument, and especially those on a blockchain, we decided that we would really rely on contract law for an enforceable obligation. So we moved forward in our best practices after we learned this in our Code is Not Law paper to come up with a set of rules, which is really just a fancy way of saying it's a contract between multiple parties. So all the parties are agreeing, yes, we are going to adhere to these terms, and those terms are the rules. So those are really embodied in our best practices document. And we do rely on Delaware law, as Rebecca mentioned, for the DLPC, the payment commitment itself, as to kind of, help with that one piece and make the commitment of the parties very, very clear. So you're adhering to the BAFT rules. If there is a dispute, we do recommend that the DLPC be governed by Delaware law and take that dispute to Delaware courts, because they have adopted the UETA, and they recognize digital negotiable instruments. They recognize digital signatures. And so it's more likely that the dispute will be the result of a dispute will come out as the parties generally planned and generally expected, just as if that commitment had been on a piece of paper. So that's where we ended up, and we think it's a good, solid framework, legal framework for folks to follow moving forward. Of course, we are still in close contact with the Uniform Law Commission. They continue to work on amendments to various articles of the UCC to modernize that statute. And then we've also been looking at possible, BAFT has, along with some of its legal experts in the field, law firm members, into perhaps amending the e-Sign Act to also help with the digital signatures and the transfer of the instruments that may be turned into, finally, from paper into a digital form. So we're working on this in many different layers. And as Rebecca said, the last element of what law you're using in the technical best practices really allows users of the DLPC to place in there, and it gives you some wiggle room to show, okay, are you going along with the best practices we've set forth and the use of Delaware law, or has now the law finally changed and there are other statutory laws on the books that are more commonly used, like New York law? Has New York law now changed going forward? So it kind of future-proofs the DLPC to some extent. And we think that is, in fact, key. The interoperability and this legal framework are very key to the success of the DLPC.
Okay, thank you very much, Samantha. And I think we'll definitely go into a little bit more detail about that later. And I can see there have been a few questions about the types of law, and looking, one of the questions is asking why not English law, for example, with respect to commodity finance. But we'll go on to that question a bit later. I'm going to take a bit of a step back and I guess segue a little bit and discuss how the DLPC fits in with other blockchain and digitization initiatives in the trade space. And I'm going to I'm just actually going to show our periodic table of digital ledger projects that we did with Emmanuel Garnet at the WTO and also the ICC recently, looking at some of the many different projects, consortia, networks, etc., that are going on in this space. And actually, Alyssa, I'm going to hand over to you, given that you have a really good oversight of lots of the other initiatives going on within the space. How does DLPC fit in with other projects and initiatives within the trade space? And I guess I'd like to refer specifically around standardization and also some of the interoperability projects here.
Cool. Okay, so I think I would actually split those into two separate parts. In terms of how it fits into the interoperability question. I mean, interoperability is always the first thing that people ask. Okay, I'm going to deploy this blockchain application. How do I make sure that I can get assets either from another blockchain application or transfer those assets to another one? And the answer is, unless you have a framework where the state objects are represented in the same way, you can't really do that. Or, let me take a step back. You can do that, but you need middleware for it, which is the whole reason that digital islands formed in the first place, was because you had these bespoke applications that needed middleware to deal with each other. So I think, in terms of how DLPC sits into the technical question about, interoperability, it provides one way of standard representation of the DLPC, such that once interoperability becomes something that makes sense. I mean, because today the projects are largely too small to need to transfer assets between them, but that's the goal of all of them. And certainly that will, that is the next stage. So when that goal becomes, when everybody's ready for that, the DLPC does sit in that ability to create a standardized object to allow that. So that's where it sits technically. So it sort of builds the technical infrastructure that we'll need in the future. In terms of standards work, we've seen, and Samantha had talked about this earlier, a lot of work from all different kind of sectors on the standards around electronic documents, electronic signatures. These are not specific problems to blockchain, but there's something that blockchain needs in order to offer the full functionality that it could do. The reason that we need standards around this is because there's a lot of questions about electronic that aren't answered in the law yet. So, for example, if you're using an electronic document, what does it mean to be original? What is an original electronic document, and how do you prove that? Unclear. So, we see a lot of work. The ICC is doing a lot of work with the Digital Standards Working Group, really updating ICC standards to make sure that they work for digitized trade and for trade finance that's done on blockchain. We also see the work that BAFT has been doing. The Digital Standards Initiative now has been formed, which really looks very broadly at when you do have these blockchain-based initiatives, what are the kind of rules that we need? So I'll kind of stop there. In case there's any follow-up, but largely it's about the technical infrastructure that needs to be built, but very much also the legal infrastructure that needs to be there. And there's a lot of groups working together to do both of those things.
Thanks, Alyssa, and I'm sure people have a few questions at the end. I think we'll go back into the functional role of the DLPC. And Rebecca, I'm going to hand over to you here. Can you provide us with a reference point or an analogy in the current trade finance space, or perhaps with reference to a specific deal, to help some of our attendees understand the structure and the function of the DLPC? And I'm going to point to our diagram here of the DLPC and how that works currently.
Yeah, absolutely. So let's stick with the example that you have in the diagram, which is a letter of credit. And so what's drawn on the diagram is actually how the DLPC and the blockchain platform would be interacting with the existing systems. So you see references here, for example, to an ERP system, a trade system, GL, things of that nature. So there is really one takeaway from this particular diagram. And then I'll get into the specific mechanics of how you execute an LC using the DLPC. The one takeaway from this particular diagram is that no blockchain platform operates in isolation. I think that every blockchain platform that is doing business nowadays has learned that double entry of information, whether it's for an enterprise customer or for a banking system, is not going to fly. And so you need to be able to take data from existing legacy systems in order to complete the entire workflow for a transaction. So it should usually not be the case that people are entering in the 13 fields of the DLPC sort of greenfield in some web interface. We should be taking that information directly from an existing legacy system. And similarly, the DLPC lifecycle should be executed with data that is flowing from existing systems as well. Now, with respect to how do you actually use a DLPC in a sample transaction, I'll go into live transactions that we have later, but for purposes of anchoring the use of a DLPC with an instrument that is familiar to all of us, start with a letter of credit. So the important thing to remember when you implement a DLPC is it is all about the payment commitment. And so you're tracking commitments, okay? That's the first thing to remember. So what usually starts an LC lifecycle is that the applicant is going to go to their issuing bank and ask for issuance of a letter of credit to a beneficiary. At that point, the applicant is actually committing to the issuing bank that whatever amount they're asking for coverage under the LC is something that they have. And they will, in the end, make the issuing bank whole for putting out that letter of credit on their behalf. So the first DLPC is issued actually from the applicant to the issuing bank. Okay. So that's what kicks it off. There will be a second DLPC that will follow from that, and that is from the issuing bank to the advising bank, because that is where the initial payments will flow once there's e-presentation of documents. A third DLPC is going to be from the issuing bank directly to the beneficiary. So that's another commitment that's made. And then finally, a fourth DLPC is from the confirming bank to the beneficiary. Now, how these DLPCs are going to be discharged is entirely dependent on the contractual obligations that underlie them. Now, for a typical LC transaction, what will happen is the beneficiary is going to kick this off by presenting the documents. The advising bank is going to have custody of those documents. Those will be sent over to the issuing bank, and the LC will go ahead and be discharged. So the order of DLPCs that I just mentioned there are going to be discharged in reverse order first. And that way you get through an entire life cycle for a letter of credit transaction. What is probably going to happen, we anticipate just from a business point of view, is that the DLPC is going to have the highest value proposition for open account transactions. Because this is where the parties are comfortable with the fact that there is no actual bank guarantee behind the payment from the buyer to the supplier. However, there are instruments that underlie this particular instrument, and using those instruments to obtain financing, for example, is going to be a key value proposition here. So those transactions are going to be a little simpler in the sense that you have a DLPC that is going to go from the buyer to the supplier. In those instances, the DLPC is usually backed by either the master purchase agreement itself or by the purchase order. And the supplier can take that DLPC and take it to a bank and get that discounted, for example. So that's a much simpler flow compared to the letter of credit transaction. But just to give you an idea of how a DLPC could work in trade instruments that we're all pretty familiar with, and then in terms of potentially more complicated structures, we can go into that for the live transactions.
Yeah, thank you. And I guess before we go into the live transactions, Samantha, how do DLPC best practices actually help facilitate the processing of a single transaction across those two solutions sitting on a different distributed ledger platform? So for example, let's say SKU Chain's technology working with Corda.
Yeah, so that's where the rubber really meets the road, where it really counts. So as Rebecca was saying, with the 4 different DLPCs, there are 4 different DLPCs because there are commitments being made to different parties. And then you're kind of unwinding, checking off those commitments as they are fulfilled through each stage of the whole transaction. And you want to make sure that the blockchain helps you make sure that that is tracked well, and that all of those 4 commitments are all tied together under one ID, one larger transaction. They're all linked together. And as you could imagine, if this transaction is taking place over 1 or 2 or even 2 different blockchains, solutions, that it's, infinitely more complicated. So the DLPC really helps in a number of ways. First of all, it takes the paper out of the system, because we've been trying to do that for a while in trade finance, because obviously it's just much more convenient to be dealing with electronic documents than paper documents that have to actually exchange hands and could be fraudulently altered in the process or lost. And then in these days with COVID, no one wants to actually touch a piece of paper or no one wants to get close enough to another person to hand them a piece of paper. And a number of the document delivery services, folks are sick, folks are under quarantine, lockdown orders at home, their documents can't even be delivered if you wanted to deliver them. So it's really brought this problem to a crux, to a pinnacle where we do have to take care of it. And so it was just fortuitous that all of our work culminated here. So now we have it digitized. We're taking advantage of the distributed ledger technology for making, one true source of information that only the parties to the transaction can see, not other parties. There's an auditable record of where this payment commitment has gone, if it's been fulfilled or not. And then thirdly, even if the same exact platform is not being used, this can transfer from one platform to another. So if the exporter is on one platform and the importer is on another, they don't have to then invest $1 million to go get involved in another consortium of folks to do a deal with the folks that are on that platform. These are very expensive things to get involved in and build out and then integrate into your own back office. It's just not tenable to be in every consortia and in every platform. So it really makes the network effect so important that you can be on one platform, but you can talk to others and do deals with others that might be on a different platform. So just moving into the case studies that Rebecca is going to cover, SKU Chain came up with a technical bridge between the SKU Chain platform, which is based on Hyperledger DLT technology, and then the Corda platform, which has been specifically built for financial institutions by R3. So it's still distributed ledger technology, both platforms. However, the architecture is slightly different, the setup is slightly different, and there are different players backing each of those platforms, different parties. The DLPC allows the most important part of a financing to transfer and still work on another platform using the bridge that SKU Chain built, the technical bridge, which is actually pretty amazing. And we think it's one of the very first times that the DLPC has been adopted, our best practices has been adopted, and now they're being used in these live transactions. And it's a really groundbreaking development, and we're really proud to be working with our members, such as R3 and SKU Chain, on this important work. It's really quite groundbreaking, and so I can't wait to hear, have our audience hear a little bit more from from Rebecca about these live transactions, including one that involves personal protective equipment in an open financing. So perhaps we should turn it over to her to hear all of those details.
Yeah, no, absolutely. And Rebecca, over to you. And let's start with the large Japanese bank example, and I guess, documentary trade finance. Can you talk us through this transaction and how it really works? Because I think great for the audience to hear a real live case study.
Yeah, absolutely. So thanks very much for that, Samantha. And it's nice to start off with this particular live transaction because it dovetails very nicely into what Samantha was just talking about, which is the bridge that we built between our platform and the Corda network. So the motivation behind that is QChain is a supply chain platform primarily. And so our customer base is all large corporates who have deep supply chains. And so the platform is really driven to satisfy their needs. When it comes to supply chain finance, these corporates are the ones who will be issuing the DLPCs in all likelihood because they are acting in a capacity as the buyer. However, their bank partners who would actually be financing the DLPCs or taking the DLPCs and creating guarantees out of those are going to either not be on a blockchain platform or going to be on another blockchain platform. And so the idea is exactly as Samantha said, are we going to ask that these bank partners or other financiers go onto the QChain platform in order to participate in these transactions, or is there an easier way to do this? A lot of the major banks are on the Corda network. It has been architected specifically for the execution of financial transactions. And so the idea behind this interoperability was, say for our customer, for this particular live transaction, if they wanted to work with a bank that was already on the Corda network, then we could take the DLPC and transfer it to that bank's node on the Corda network. Or if they wanted to use somebody else's node, then we have an agent node on the Corda network that can act on their behalf. But the idea is that you're not forced to onboard onto a brand new platform in order to participate in time-sensitive transactions. So a little bit more about the mechanics of this particular transaction, because I think it'll be of interest to the trade practitioners who usually deal in LCs. So the objective of our customer, which is one of the largest Japanese trading houses, that they wanted to find a way to replace the letter of credit. Now, nothing will entirely replace the fact that a letter of credit is essentially a bank guarantee. There's a lot of legal jurisprudence around LCs. It's pretty predictable how LCs will act in the market. And it's very hard for a new instrument to replicate any of that. And so it's not a direct replacement for an LC. But if you are looking to transfer to open account, either for cost purposes or to increase your trading capacity, however you want.
Rebecca, I think we're losing you slightly. I'm not sure if other people are also on the call. Can you hear me? Can you say something again quickly?
Yeah, can you?
It's cutting out a little bit.
Hello?
Say
can you hear me?
Again.
Yeah, can you hear me now?
Yeah. Did you want to say that? Yeah. Did you just want to say that last sentence again?
Absolutely. Dipesh, were you able to hear that?
No, I'm afraid we weren't, and I'm actually going to ask if we can switch over to Samantha to talk through one of the other case studies, if that's okay with you, Samantha.
Yeah,
at least just giving an overview.
Yes.
Great. So if you can talk through the case study.
I'm sorry, Dipesh. I was talking over you.
if you can talk through the PPE case study, that would be great.
Sure. So you'll notice with all of these charts that you're seeing before you, they also appear in the DLPC Best Practices document as they're really just an example of the flow. So as Rebecca kind of mentioned before, there were a lot of questions about both the Delaware law, questions, do we have to use Delaware law? And there may be questions about these flows as well. You're under absolutely no obligation to structure your deal just like we have in any of these flows. If we're talking about a letter of credit, you do not have to set up your letter of credit like we were just speaking about in the previous slide. It can be very, very different in the business side and with the steps in the DLPC as well, as long as certain information is provided in the DLPC, technical information, and then it's transferred in the correct way, it all will work. So Alyssa can probably discuss a number of these factors too, since she works so closely with SKU Chain on these two particular case studies. But with the open account transaction, there's a major regional bank that is providing the financing. So as most of the trade practitioners know, especially the smaller providers of equipment or goods, really to keep their cash flow coming, they send out the goods, export the goods, and they need payment right away so that they can build more of the equipment to then send out again to a different buyer. So, but usually the commercial terms are the importer doesn't need to pay the exporter for 60 days or 90 days. And especially if it is a small organization, they need that funding right away. They need to be paid right away so that they can go and buy more raw materials and make their products. So in this case, actually, that Rebecca was going over, this is emergency equipment needed to fight COVID and to get equipment into the hands of doctors and nurses working at hospitals trying to treat COVID patients. And folks have stepped up to the plate to make this equipment, right? And they're smaller suppliers, and they're not necessarily in the regular business of building medical equipment and shipping it out. They might do something in a related field, but they're pivoting now because of the need. So the DLPC has been issued to back up these invoices, essentially. It's a commitment to pay. So that commitment can be financed by a third party. So a third party bank, for instance, can step in between the buyer and the seller and go ahead and pay the seller immediately. And then when the commitment does come due 90 days later, the buyer goes ahead and essentially pays back the bank that paid the seller in advance. So it's a very easy way for that commitment, the payment commitment, to be transferred amongst the parties and be essentially refinanced at a discount. And it's a way to really help get this equipment that's needed and to support these smaller producers in an emergency such as we have today. I hope that helps.
Great. Thank you very much, Samantha. And hopefully Rebecca will be back online for the Q&A. Sorry we lost you at the end there. I'm actually going to... time here, but we have got time for a couple of questions, and I can see the Q&A box is absolutely full. So I'm going to jump in, and perhaps Alyssa, I'm going to start off with you, and a question from someone called Mohammed El Nagar, who's actually, I think he's on the TFG Trade Professionals program, so I will be biased. Alyssa, EU CP 600 has already been applied for traditional LCs, allowing presentation of digital documents. What would differentiate the DLPC from a traditional LC issued under EU CP?
Well, I think, unfortunately for this call, I think that's probably a better question for Rebecca. But I think, what we spent a lot of time doing in the working group is making sure that the DLPC is in line with existing regulations. So, where there are existing standards or guidelines, they're all incorporated. So, Rebecca, are you back online?
Are you able to hear me?
Yes.
Yes.
Okay. Oh, fantastic. Okay. So I can go ahead and answer that question, or we can keep going, Alyssa, and then I can answer it at the back end.
No, I think it's fine to do it now. I mean, really, it doesn't differ very much. I mean, because I think what the question is conflating is letters of credit and DLPC as two separate things. But in fact, yeah. DLPC is a piece of the letter of credit. So they're not actually different. They're not the same thing.
They're not the same thing. No, that's absolutely right. So DLPC, once again, is just the payment commitment embedded in a trade instrument. And so there will always be some sort of trade instrument that is backing the DLPC, whether it is a letter of credit, whether it's a bill of exchange, whether it's a note, whether it's a purchase order. And so you're always going to look to the underlying trade instrument for the legal obligations, for the jurisdiction, for instance, for the terms of the trade itself. So when you talk about an LC that's being issued in digital format under EUCP, that in and of itself can be the basis for a DLPC being issued. Now, you might ask in that situation, what is the value add of a DLPC exactly? So you're looking at a streamlined execution of the letter of credit across multiple blockchain networks if you use the DLPC. So a DLPC, in addition to having a legal obligation embedded in and of itself, you're able to look at it and understand what's going on in that transaction, even after you transfer it to another blockchain network. And as I mentioned before, what will usually happen with a DLPC is that the underlying trade documentation is going to be somehow attached to it, either a copy of it, a hash of it, that you can later reference on the blockchain network, et cetera. And so it is a way to essentially share the data around this transaction across multiple blockchain networks. And again, it's all in service of working towards a standard for how these trade can be executed platforms.
Thank you very much. And Rebecca, I'm going to ask you another question. Is a DLPC a undertaking? Is there still a need to issue a documentary LC to mitigate the payment risk in the settlement of a trade transaction if a DLPC is being issued to each of the parties involved? Or is it just a digital record of the payment commitment, but there's no risk undertaking per se?
Right. So DLPC, again, it is a note. It's a note under Article 3 of the UCC as adopted by the state of Delaware. So it does represent a legal obligation. Now, you might ask, what is the difference then between a DLPC and a letter of credit? Now, obviously, a letter of credit, it's a legal entity in and of itself. It has a bunch of obligations, and more importantly, the jurisprudence and the history around the DLPC is a newer conception. It is based in existing instruments and the legal obligations that surround those instruments. But the DLPC in and of itself is new. And so it doesn't have the same benefit of the legal history and, again, the jurisprudence that a letter of credit would have. So it depends on what you're trying to accomplish, I would say. If you want the same guarantees that come with a letter of credit, if you want a bank on both ends of the transaction to basically be quarterbacking and guaranteeing transaction and playing that middle role, then I would stick with the letter of credit and use the DLPC really for its digitization benefits. However, if you are comfortable not having banks in the middle quarterbacking the transaction, and you are willing to rely on the fact that a DLPC is an enforceable note under law, then you can have the DLPC basically back an open account transaction, but add that extra layer of security to it. So to directly answer the question about whether this is an undertaking, it's very, very similar. It is, again, a legal obligation in and of itself. If you take it to a bank, they will be able to treat it as a legal obligation and to advance cash based on it, to use it as collateral for another kind of financing. But if you're asking about what the difference is between how we do things now and what would change with the DLPC, then that sort of encapsulates it.
Thank you very much, Rebecca. I'm going to ask a question to Alyssa now, which is I guess something that a few people on the Q&A have brought up, which is around the acceptance of documents. Do you foresee the use of electronic documents on the whole supply chain? And I think a lot of people's opinions on the chat is the greater issue is the lack of acceptance of the digital documents in certain markets.
Right. Well, I mean, right. So when you're talking about a global supply chain, you're always going to default to sort of the lowest common denominator, right? And that is the issue with paper and digital, is if you have one actor in the chain that doesn't accept digital, then you need at least in some way to be able to make the document paper and still track it digitally, which becomes a challenge. Though, to be fair, all of the different blockchain applications recognize that and have accounted for that. DLPC as well. I know there was discussion in the working group, how that would play out because you are doing this tracking. So I think the question is correct. Like when you do have one party that demands paper, you don't necessarily have to make the entire transaction paper, but you really need to think carefully about how are you able to go off chain and then come back on chain in a way that retains the originality of the document, retains the legitimacy of the document. So that would be one part of the answer. The other part of the answer is, we see digital happening everywhere. And the more important question is really around integration into existing ERP systems. So what you're not doing is requiring additional work to, input this data into a particular document or generate a particular document. You generate it natively from the data that's already there. But of course, this raises the additional questions around, what if you're using an electronic document, what constitutes an original? That's less clear. So I think there's a whole host of issues that the industry is still working through. Supply chain is certainly behind, what's happening in trade finance. Because with trade finance, it's a lot more straightforward what the documents are. And just a final point around bills of lading, which is really the problem. And potentially that's what this person is getting at. Bills of lading in most countries have to be paper. And that's the fundamental, title document of the document pack. And so, but there's been so much work being done on electronic bills of lading that I think we'll see that moving forward in the next year or two.
Great, thank you very much. So I think that's answered the large majority of questions in today's webinar, but I think we're going to call it an end to a great session. So thank you very much to Alyssa DiCaprio, Rebecca Liao, and Rebecca Pelosi for their great efforts here. Available to download the latest version on BAFT's website. And also this webinar has been recorded and it will be available on demand to those of you who have been unable to perhaps hear all of it, and hopefully we've answered your questions. If you have any further questions, or if we were unable to answer your questions, please email events@baft.org and